Hi guys, welcome to this Money Control live stream. You're watching IPO Watch with me, Nandita Khemka, and today, of course, we are focusing in on the biggest IPO of 2025, Tata Capital. The 15,500 crore rupee issue has opened up for subscription. Of course, it was the much awaited IPO of this year, and it has finally kicked off for subscription. Good response from anchor investors. 4,600 crore rupees raised by the anchor book, and you've got marquee names. Of course, LIC being the biggest investor via the anchor book. You have a mix of global as well as domestic mutual fund investors who have taken part in this IPO via the anchor book. But of course, to understand the future roadmap, we have with us in our studios the management Rajiv Sabharwal MD and CEO of the company to take us through the future plans, post IPO roadmap, etc. First of all, welcome to the show. Welcome to Money Control, Mr. Sabharwal, and congratulations on this issue. We're no stranger to brand Tata. This is the financial services arm of the Tata Group. Second IPO from Tata stable, recent being Tata Tech. Great response. Just going through your anchor book, ICICI approved MF, Goldman Sachs, Nomura, Morgan Stanley, Amansa Holdings, a whole lot of marquee names have participated via the anchor book. What are you feeling? Are you confident this will sail through? And secondly, we know that the fresh proceeds will be used to augment Tier 1 capital. Currently, the Tier 1 stands at 12.8%. What is the outlook post-IPO?
So, Nandita, we've got a great response from the anchors, and the whole thought was to get more long-only investors, and we've got the best names there, whether it's Goldman, Morgan Stanley, Amansa, we've got the best names there. In terms of mutual funds, we've got 18 mutual funds participating here. We've got a lot of life insurance companies led by LIC. All pension funds are there in there. So we feel that that book is with long-only investors, and our effort would be to ensure that we give good investor returns. That will be our effort. In terms of utilization of proceeds, this will shore up Tier 1 capital, and along with the profits which we earn, we believe this can support growth for the next 2.5 to 3 years. In terms of our capital adequacy, this will improve to 22% plus, and our leverage ratio will drop to below 5. But as we utilize more of these monies into growth, these ratios will take shape.
Sure. Any part of the proceeds that would be used for acquisition or sprucing up, the fee-based businesses from this IPO proceeds?
So we have consciously believed that organic way is the right way. Our team believes that we know our business well, and that's the reason we want to grow organically and not to look at any inorganic in the lending space. If you look at where these proceeds will be, we will continue to invest in technology and now Gen AI, which will help us in making our products more efficient to the customers. In terms of fee income businesses, we are present in wealth management, and we intend scaling that business significantly.
Sure. Your gross loan book, I think it stands at somewhere around 2.3 lakh crore rupees. Of course, Shriram Finance is quite close at 2.7. Post ambitions, what are your, post IPO, what are your ambitions in terms of your gross loan book?
So, we are present in a market which gives us an opportunity to grow. If you look at the Indian market, growth is getting supported by two things. One is obviously the GDP growth, and the other is the penetration of credit that is also growing. I think these two offer great opportunities. The other thing which we have seen is that even if India grows at about 11 to 12%, retail and SME tend to grow at 17 to 18%. And for us, 88% of our book is retail and SME. So to that extent, we get that tailwind with us. If you look at the past few years, we've been growing at 25% plus. I can't talk about the future, but I can talk more about what we have done and what has helped us grow there. The other thing which we feel very, very good about, while the growth has been at this pace, we've also kept the credit cost at one of the lowest in the industry. So it's a combination of these two which has helped us.
You confident of maintaining credit costs at those levels going forward?
Our team is committed to it. We believe we are in the business of risk management, and always quality comes before quantity. We are proud of what we have delivered on credit costs, and our effort will be to continue that in the future too.
In terms of unsecured as well, you brought it down to 20%. It was in excess of 24 or 20% earlier. Would you be looking to reduce it further? How are you looking at the unsecured side of things?
So if you look at retail unsecured, which is the one which got into a lot of news over last year, and RBI also made certain changes under the previous governor there. So if you look at that business forms less than 12% of our total book. We did bring it down when we saw challenges in the industry, but now when we look at our own credit costs, we feel the worst is behind us. And with all the steps which we have taken, all early signs point towards something where I would say the highest credit cost is behind us. So with that, we will watch for a few quarters, and if that trend remains good, then we will look at how we can scale that up.
Sure. Let's talk about profitability as well. You've maintained a CAGR of 11%, I think, since FY23, and I think in the first quarter of FY26, profitability was pretty strong. You saw a multifold jump if you compare it to the same quarter last year. What led to that, and are you confident that levers are in place to continue at this pace?
So, if you look at our profitability, I would just want to highlight one aspect there, that we got the approvals for the merger with Tata Motor Finance in May of 2025. However, this merger dates back to 1st April 2024. So some of the ratios incorporate this. If I take away the Tata Motor Finance merger, where we got the final approvals just 3-4 months back, then our growth rate on the book has been over 25%, and our profits have grown at about 28% plus in the recent past. Because of this acquisition, some of these ratios are not comparable with the previous period, but the true facts are what I just told you.
Two things I want to discuss with you. First is asset quality, especially after the TMFL merger. There, of course, the GNPAs are much higher at 7.1%. How are you looking to integrate that, and what's your outlook on asset quality going forward? And of course, how are you looking at integrating sprucing up the vehicle finance end of the business?
So, if you look at the commercial vehicle business, that was a business we are not present in. We are, as Tata Capital, we were present in passenger vehicles, two-wheelers, as well as used passenger vehicles. So, the commercial vehicle market is a large market. It's a 10 lakh crore market with annual disbursements of about 1.5 lakh crores. So, we believe that with this, we will get an opportunity to be present in the commercial vehicle space. Now, with the merger of Tata Motor Finance coming in, since we are not a captive finance company, we have now started working with a lot of other OEMs also. So to that extent, we will be a multi-OEM business. All the learnings which we have had on the credit side, our learnings on the digital side, we are all embedding it within the Tata Motor Finance book. And also in terms of efficiency, cost to average assets, there's a lot of effort happening to bring that down. With the merger of these two entities, the cost of funds of Tata Capital was lower than Tata Motor Finance, so that benefit is also accruing to that book. So we do believe that we have put in a strategy in place which will get us to industry leading ROAs in that business too over a period of time.
Okay, I think that sprucing up return ratios was one of my questions, but I think you've answered it here only. In terms of margins, I want to ask you, it's around that 5.2% mark, right? But peers are way ahead. Some of them even 8-9%. In a rate cutting cycle, what are the, what is the outlook that you have on margins? Would you be looking at higher 7-8% over the next 2 to 3 financial years?
So let me put it from an ROA perspective, because ultimately it all flows down into the ROA.
Yeah.
If you look at our margins, when I talk about NIM plus income, my total income, that's over 6%, 6.1, 6.2% in that range. Because we are also into fee businesses, so we are, adding that up. what we are doing in terms of strategy is to increase our proportion of high margin products.
Okay.
If you look at our housing finance company, it's one of the best performing housing finance companies in the industry. There we are increasing the proportion of affordable housing there. For example, we have already reached a level where we are among the top 2 or 3 players in affordable housing on incremental business. We have launched micro home loans also. On the SME side, we are growing up equipment finance as well as leasing, which are again high margin products for us. So one effort is to increase margins. 2, we are seeing the benefit of lower cost of funds also playing with us. We are rated AAA in the domestic market and BBB by S&P in the international market. Our cost of fund, because of this and the brand we belong to, is one of the lowest. So that will also help us, because you know that the true benefit of cost of funds will start accruing in Q3 and Q4. The third thing is we are seeing a big shift happening in cost to average assets because of use of technology as well as Gen AI now.
Okay.
Both will give us a step improvement, not only for us, for the whole industry, if used properly over a period of time. And the last is we've always had credit costs below 1%, and our endeavor always will be to be back in that comfort zone of ours. So I think from an ROA perspective, all these count towards it, and we have a strategy in place working on each one of them.
Sure. I think there's a paucity of time, but I want to just ask you one last question in terms of the proposals that RBI announced along with the monetary policy. You know, a lot of stuff when it comes to the banking universe, right? Acquisition, allowance of acquisition by banks, acquisition finance, if I may say so, then reducing weightage for infrastructure financing as well. Quite a few other measures. How do you see Tata Capital being impacted by any of them?
So actually, banks and us have complementary businesses. I think we do get a lot of support from them, and we work along with them on a lot of areas. Anything which helps expand the market is always good for us. Because if there are more opportunities for M&A, there are going to be more opportunities for lending. There will be more entities, there will be more growth happening. So we clearly believe that opening up and freeing up the economy such that more lending can happen, if more credit growth can happen, we are a part of that system, and we will too benefit from it.
Okay. A last question really, where do you see Tata Capital over the next 5 years now that it has, of course, made its D Street debut, so to say, and any message to the shareholders, prospective shareholders?
The message to the shareholders is this, that we are working very hard to make Tata Capital deliver on all its promises and do better than that. In terms of where we want to be, we clearly want to build a portfolio which is very resilient, which not only performs in good times, but also performs when times are not good.
Sure. Okay, message received, and I would like to thank you for taking out time and coming to our studios. All the best,
Thank you so much.
I hope to interact more often now that you have
Yes.
made your D Street debut.
Yeah.
We will try and touch base every quarter to take stock of your quarterly earnings as well. With that, thank you. Thanks a lot.
Thank you so much.
Thanks a lot. Thank you, viewers, for tuning in. Of course, stay tuned to Money Control for all your other news and updates. And of course, I'll see you later in the day. Thank you for watching.